Switzer. It's now time to get inside the head of the investment expert extraordinaire, Roger Montgomery, the Chief Investment Officer of Montgomery Investment Management. And his subject tonight is Harvey Norman and some stocks he really thinks are worth investigating. Welcome, Roger.
How are you?
Very good. Now, I know you want to start with the big picture first, but I thought they were probably the sexiest topics that people would care about. Everyone loves Jerry, and I think a lot of people hopes he can make it. Obviously, the share price has improved, but let's talk about the big picture that you want to start off with first.
Yeah, okay. So what we've seen, of course, is traders on the New York Stock Exchange high-fiving each other.
Yes.
Because the Dow Jones finally got to the point where it exceeded the highs made prior to the GFC.
Yeah.
So what I want to briefly just explain to viewers and investors is what's going on. And fundamentally, what we're seeing, of course, is an extension of low interest rates. So we've got this ZIRP in the United States, zero interest rate policy. Once interest rates are at zero, you can't lower them anymore. So the only way you can make money even cheaper than when rates are at zero is to just give it away. And that's what quantitative easing is. And so we've had some conflicting messages from the Federal Reserve Bank in the United States. So we've had Bernanke come out and say it's there forever. There'll be no...
Or at least when unemployment gets to 6.5%.
Yeah, right. Yeah. So it's going to be there for a very long time. It won't be altered in the immediate future.
Probably 2014 looks logical.
Janet Yellen is sort of touted as being Bernanke's replacement. Yeah. She's equally dovish.
Yep.
She believes that we should have low interest rates for a very long time.
And Simon Bond explained dovish to everybody, so everyone's comfortable on dovish.
Good, very nice. The opposite's hawkish.
Yes.
And so we've got this zero interest rate policy, and we've got excess liquidity. And what happened in January is the Federal Reserve Bank of New York came out and they said the period of, quote, the period of maximum liquidity is nearing an end.
Yeah.
And then the market got a little bit... Well, it rallied initially and then got a little bit scared. And nobody wants the stock market to go down, even for a day. Yeah. And so Bernanke came out and said, look, it's all on again.
So did James Bullard, the appropriately named Bullard, came out. He's the St. Louis Fed president.
Exactly, same sort of thing. And and then late last week what we had was some Chinese officials come out and say, we're committed to a strong growth economy, and we're going to focus on infrastructure. So we're going to build more of these empty cities that no one lives in. We're going to build more roads to get to them.
Don't be hard on China. We love them, Roger.
So anyway, it's all good again. But of course, what hasn't changed is this high iron ore price is resulting in a supply response. It started back in 2011 when the iron ore price hit $187 a metric tonne US. And so what's going to happen is it always takes a long time in the mining sector. The lead time between commissioning a mine and the production of a mine is a few years. And what we're going to see now is 2014, 2015, big supply response, lower iron ore prices, and some issues for Australia's resource sector. So I think the big picture is really good for Australia. Retailing's improving. We'll talk about Jerry in just a moment. A friend of mine who owns a large portfolio of shopping centres managed by institutions has been telling me that since October, turnover of his tenants, the turnover of the tenants, and you know they set the lease rates based on turnover, has been improving. So that's really good. We've seen the NAB consumer sentiment surveys come out, and consumer confidence is improving.
Green shoots are there.
It's all good except for this sector, the resource sector, which I would be very cautious about going into 2014.
But Roger, do you think necessarily that the prices of BHP and Rio, which most people care about because they're in them, are going to fall, or they'll just have less upward mobility?
Well, I like that. That's a very diplomatic way of saying they don't go anywhere.
Well, for example,
you lose money, don't you? If you buy into something that doesn't go anywhere,
3 or 4% dividend.
But you could be in other things that go well. Look, if the iron ore price drops from where it is now to where Andy Z's saying 100 or 80 or $70 a tonne, then I think sentiment will be against the shares. So you need to be careful. And Monadelphous, the A1 of A1 mining services businesses in Australia, came out and said, look, beyond 2014, there's no transparency. We really can't tell how things are going to go. And we're a little bit concerned about that.
So maybe those who've got could hold, and when the share price falls, then they buy. Waiting for 3 or 4 years after. Yeah,
you'd add to it because a lot of your viewers are self-managed super fund investors
and long-term players.
And they would have bought their shares in BHP decades ago,
Right. They're laughing their
or
heads off.
inherited them from their parents.
That's right.
And so, yeah, you're probably not going to be selling those.
Okay, let's go to Jerry.
Okay, so...
Because I interviewed him on Tuesday,
yeah.
and that will be shown next Monday and Tuesday, and he's a very interesting guy.
He is an interesting guy because he has a very different perspective to the analysts in Australia about the internet.
Yeah.
So the analysts are saying, Jerry, you're a dinosaur.
You don't get IT.
But you listen to Jerry, and he's got a very convincing argument. He said, look, I'm putting tons of money into the internet. I'm advertising our website on all of our catalogues. I'm out there on the TV plugging away, telling people about the internet. And we're not getting any traction. Yeah. Now, the analysts turn around, the analysts say, well, Jerry, that's because you're not doing it right. Yeah. You know, mind you, they couldn't do it any better.
That's right. He's actually invited a journalist who bagged him to come out and show him how to do it.
Right. But the point is made. I think the disruption to retailers from the internet is at the smaller products. It's music. It's
dresses,
small, it's dresses, it's socks,
running shoes,
you know, it's clothes, and you can make millions and millions of dollars selling that stuff online. Yeah. But people aren't going to buy a fridge online. They're not going to buy a couch or a bed mattress.
I want to see my TV and see how good it is before I bring it home. Yeah.
Now, Jerry's told me an interesting thing that the retailers are doing. He said to the group assembled at the lunch, and there was about half a dozen of us, and he said, look, what we're doing is we're pushing back to the suppliers now. We're saying, if you want us to stock 15,000 of these 100-inch television, you know, I'm just exaggerating, but, you know, big TVs, if you want us to stock 15,000 of these things, then you've got to sell them. You can't sell them to the disruptors. You can't sell them to the people who don't have a store and, you know, don't care about your brand, and they're selling these cheap brands underneath.
Is he allowed to do that competitively?
I don't know.
That's an interesting question.
He'll have to experiment with that. He'll have to speak to his lawyers about that.
They'll be foreigners, so they won't be governed by local competition laws.
No, well, that's right. And it'll be interesting to see whether or not he can do that.
Yeah.
But that'll be one way that the retailers might be able to push back and get some margin back from these disruptors. But look, Jerry's tried his heart out to get the internet going, and it's just not. It's not gaining traction, and I think it's because the products that he sells are the big ones. So he is experimenting with other products and going pretty well there. He's trying a few other things, and this year viewers will find out what that will be.
Yeah, and also he actually said to me that part of his improvement is he's got less competitors.
Yeah, exactly, and that happens. I wrote about that in your newsletter, and I said, look, what happens in retail land... I
didn't ask that question. You look smart. Yeah.
What happens in retail land is when the economy slumps, the marginal players, they fall over, they collapse, they have to be broken up and sold. Yep. And we saw that with Clive Peters and Dick Smith. And then those who've got deeper pockets, who've been around a long time, the JB Hi-Fis and the Jerry and the Harvey Normans, you know, they grab market share because the other players, the marginal players, have fallen over.
Okay.